السلام عليكم ورحمة الله وبركاته. Good morning, Dr. Khan. This is Ali Saeed Al-Ghamdi. I am going to talk about the difference between upstream and downstream sales in determining consolidated net income and the controlling and non-controlling interest in consolidated income. First of all, I divide my work to 4 parts. First of all, I will going to talk about what is the upstream and downstream sales. Then I will talk about what is the difference between upstream and downstream sales in determining consolidated net income. Next, controlling and non-controlling interest in consolidated income, and the last is practical explanation in general. So first of all, upstream sales is a subsidiary selling into the parent entity, while downstream sales are from parent to subsidiary. Financially is usually refers to loans, since dividends and interest generally for upstream. When we see this chart, it explains the upstream and downstream sales. This is the parent company and this is the subsidiary company. We can see the sales is when the sales is going from parent company to subsidiary, this called downstream sales, and the opposite is upstream sales. If the sales is between two subsidiaries, that will called horizontal sales. Now we can see if the outside supplier provide an inventory or anything for parent's company, so the parent company purchase from outstander for example 200,000, so the cost will be 200,000 for the parents. If the parents sold for subsidiary, for example by 250,000, the cost of subsidiary will be 250,000, and they may sold to outside customer by 6% of the goods. This is increase the sales for the subsidiary and for the parents. You can see this note. It is the parents who record the intercompany profit. Thus the parents' income needs to be adjusted and consolidated. So upstream and downstream. What is the difference between the upstream and downstream sales in determining consolidated net income? We can see this. The answer is there is no difference between upstream and downstream in determining consolidated net income. We can see the practical now. Barless product acquire 80% of the common stock of special food on December 31 for its book value of 240,000. The fair value of non-controlling interest on that date is equal to its book value of 60,000. On March 1, Barless buys inventory for 7,000 and resell it to special foods for 10,000 on April 1. You can see in March inventory 7,000 to cash 7,000. Purchase of inventory in April 1, cash is 10,000 and to sales is 10,000. Sales of inventory to special foods. Cost of goods sold is 7,000 for the inventory in March 1, and the inventory is 7,000. Special food record the purchase of the inventory like this: inventory 10,000 in debit and cash 10,000 in credit. So this entry does not affect consolidated net income. No elimination for intercompany profit is needed because all the intercompany profit has been realized through resales of the inventory to external party during the current period. You can see the sales to cost of goods sold 10,000, cost of goods sold to inventory 10,000, and cash to sales 15,000. And downstream also, during 2020, Special Foods receive 15,000 when it sells to non-affiliated corporation the inventory that it had purchased for 10,000 for Barless. Also, Barless record its pro-rated portion for Special Foods, its income and dividends for 20 with the normal basic equity method. So this is the method we use. Cash 32 to investment in Special Foods 32,000, investment in special food stock to income for subsidiary 60,000. Also the upstream by the basic equity method, cash is 32, investments in special food stock is 32,000. The other transaction is investment in special food stock 60,000 to income for subsidiary included 60,000. As in the downstream example, the investment account balance at the end is 284,000. The consolidated work paper used to prepare consolidated financial statement at the end prepares in figure 7.4 as we explained in the past. So we can see this the practical income for subsidiary 60,000 to dividends declared 32, and the difference will be investment in special foods stock 28,000. Also income to non-controlling interest 15,600, and the credit is dividends declared 8,000, and the difference will be non-controlling interest, which is 7,600. Common stock special foods 200,000, return earning 120,000, to investment in special food stock 256,000, and the difference will be non-controlling interest 64, and that also return earning 2,400, non-controlling interest cost of goods sold is 3,000, and the difference is non-controlling, which is 600. The next subject is controlling and non-controlling. So we will show the effect of the non-controlling and controlling interest. If the transfer is downstream sales, then any resulting of unrealized gain belongs to the parents. No effect on non-controlling interest. If the transfer is upstream sales, then any resulting unrealized gain belongs to the subsidiary. Non-controlling interest must be adjusted for the unrealized gain. So, controlling and non-controlling interest are affected differently. For downstream sales, the elimination of intercompany gains as well as the subsequent depreciation adjusted affect only controlling interest. So it's affect only the controlling interest in downstream. For upstream sales, the adjustments are made to the subsidiary income, and those affect both controlling and non-controlling interest. So in the upstream, it's affect the both controlling and non-controlling interest in preparation of subsidiary ownership. This is my reference, and thank you for listening.